Our perception of money is changing rapidly, and banks are at the center of all of it. From how we access it, to how we buy, to how we trust that money will be there when we need it. I'm Kiah Haslett, the creator of Fintech Takes Banking. Here on Bank Nerd Corner, I talk with bankers, economists, academics, and more about the complex dynamics shaping the financial services landscape. This week on Bank Nerd Corner Squared, Alex and I try to keep it light as we chat about the holidays and our thoughts on LinkedIn versus Twitter before moving on to a couple of bank topics. For the most part, the new year has been pretty light on serious bank topics. We chat about the interesting trend of fintechs buying banks, especially compared to the de novo charter applications we've seen from fintechs. We then move on to some not great news for the industry, including President Donald Trump's proposal to cap interest rates on credit cards at 10%, the grand jury subpoenas sent to the Federal Reserve Board, and the announcement that the Trump family's cryptocurrency firm, World Liberty Financial, would apply for a national trust charter. In an attempt to lighten the mood, I close us with a small credit card rant. Hey, Alex, how are you?
I am doing well. Happy 2026, Kiah Haslett.
Happy 2026 to you. How was your holiday? Did you get a snowblower?
No, I did not get a
no.
snowblower. It's fine. I think what happened was I didn't get a snowblower, but then the weather gods just agreed that it wouldn't snow. So I haven't needed it. And I think I would prefer to live in the alternate universe where I have snow and a snowblower, but at least I can live a consistent life of if I'm not going to have a snowblower, there won't be any snow.
Right.
And so I've had the flip side to it, which is fine.
Yeah, that's great. It is. It's finally cold in Nashville. It cold enough that I had to run my hot water through the pipes yesterday all night. And I'm not emotionally ready, but intellectually I understand it's January and
Sure.
This is the bargain. This is the time of the cold. But it was like 50s and 60s last week. So the shift is really
cold.
jarring.
When you say that's cold, that's what cold is. 50s and 60s.
Well, it's 30 now, which is cold.
That's cold.
50 and 60 is nice. And it's even nicer in January.
Just to tell you kind of what a weird winter it's been so far. It's 50 right now in Bozeman.
Oh, what?
So yeah, things are totally weird and upside down. I'm looking at the forecast. It's supposed to get colder, but not cold, and there's no snow. There's no snow.
Not a hair of a snowblower.
No. So I guess it's good that I didn't get a snowblower because there would be zero chance of being able to use it. Did you get any gifts that you were pining for?
I kind of don't think so. I'm trying to remember what I got. I got some jewelry.
Okay.
I got some food, which I love food as a gift, always.
I didn't know that.
And it was a pretty chill Christmas. Read a bunch of books, watched the hockey show that everyone's talking about, which I will spare you because you refuse to watch it.
No, that's not true. I watched some of it, maybe not all of it. Maybe it gets better. We'll have to revisit this topic.
I think it starts high, ends high, but yes, there. That's a different podcast.
This has been a subject. This has come up a lot in the group chat.
Anyone can send their thoughts to me. This is also an open call. I am accepting all bank nerd comments and then also separately any memes or comments. Reels about the hockey show.
Okay.
All right. So, and I'm going to see you in a couple of weeks.
Yes.
We have a work week retreat coming up, so that'll be fun. Mm-hmm. And then we have the start of what I guess is the winter-spring conference season. And you and I will both be at Utah's FinTech Exchange in early February.
Yes, I am looking forward to that. In fact, I was looking at the agenda and either I go right after you or you go right after me, but we're back to back on the agenda.
Oh no, we can't watch each other's stuff then.
Not as much. I'll be watching from backstage. But I am very excited about that event. I feel... I don't know. You probably have some conferences that happen in Nashville or the surrounding areas from time to time. Mm-hmm. It's nice. Not having to travel all the way across the country or, God forbid, go to Vegas. I love going down to Salt Lake. So I am very much looking forward to that event.
Yes. And if you missed it, I did share some physical therapy stretches if you're going to a conference and maybe could potentially ski in that same area and you just want to make sure you are prepped physically for that conference, require those physical demands of the conference on my LinkedIn. So
my question for you, Kiah, before we get into the content for today's show is, if you had to distill down the 3 different like things that you could get by following you on LinkedIn or Twitter, what would those 3 things be? Because I don't know that people know that like stretches and strength exercises and pretty specific thoughts on like kinesiology would be a thing that they might get from you, but they do. So that would probably be one, right?
Yeah, I think there's a lot of benefits to following me on all socials.
Sure.
And I've been trying to be a little bit more active on LinkedIn. But also, I think I've told people before that LinkedIn feels like a different version of me. And I think sadly, I think my true id is lives on Twitter.
I think so too.
Which I'm on Twitter less, but when I am on Twitter, that's the most authentic version of Kiah.
Yeah.
And I'm trying to be like funnier on LinkedIn, which is such a weird personality aspect to have. So I thought that the physical therapy stretches would be useful, but also funny contextually. And then today I shared a post that was about the mental value of money. And it was about whether is like $8 in your head closer to $5 or closer to $10.
Oh, you sent me that article. Yeah.
Yes.
Yeah.
And but then someone replied like, $8 is $8 and rounding down could be financially irresponsible. And I was like, damn it, this is why being funny on LinkedIn is so hard, because like people just won't go with the joke.
Well, that's the thing, right? Is that I find sometimes like my best little like jokes or little observations are on Twitter. And I do sometimes feel like, oh, maybe I should bring this over to LinkedIn. But I have the same thought you do, which is the people here don't come here for that. They don't do that here. And so even if I think some people would see it and appreciate it, it doesn't get that same like back and forth. Whereas Twitter, for the nightmare that it is in almost every single way, it is filled with like smart, sarcastic people with quick fingers, and you get a little more back and forth, which I do like.
Yeah. And the other thing that I did on LinkedIn sort of recently was I was being sarcastic and ranting about the OCC's semi-annual risk perspective and how like unimpressed I was with it. And I was like, I couldn't decide if I should go with like, I'm not angry, I'm just disappointed.
Kind of, yeah.
Or if I should like
sort of vibes.
Make fun of them, which is like a little bit closer, I think, to my real personality. And two people messaged me to be like, thank you so much for sharing that. Like, I agree. And I was like, okay, that was a bit like, maybe the OCC will never talk to me again, but like, I'm already not talking to them that much. So it didn't feel like a lot to risk, but
you weren't
I was just like,
much.
Yeah.
That's funny. I mean, I remember going back, this was a while ago, but I wrote a piece, and I think the title of it was, does the OCC know what banking as a service
I remember this piece because it's iconic.
And it really was. And it's funny going back and reading it because so much has changed. But I will say, to that point, sometimes like some direct criticism does work, because I then had folks from the OCC reach out and be like, this is a totally fair point. Do you have any thoughts you'd like to share with us about this? So sometimes being your authentic self does solicit the best response. And maybe that's a good resolution to take into 2026.
Totally. Yes. Being more sarcastic and funnier on LinkedIn under the guise of being authentic self. Yep.
Yes.
Okay, so let's talk about some bank stuff. I was kind of scraping the barrel on some of these topics this week because, as we'll get into it, there is a lot of stupid stuff happening right now that I would love to ignore and but can't. But first was like a dorky little sub-trend that I felt like I saw different times happen in 2025 that I think we should talk about just as an emergent trend between our two areas, which is fintechs and banks, specifically in the acquisitions arena, which I had spoken about basically all last year.
Yeah.
The reason why I wanted to talk about it was the December announcement that Grasshopper Bancorp would be acquired by novo, which is a fintech subprime consumer lender, I believe, or a consumer lender, maybe not subprime, for $360 million.
They are very subprime. Yeah.
Okay, so for $370 million. And that followed a couple of other similar types of announcements. So there was the November announcement that Green Dot would be splitting itself and selling its fintech arm to a private equity firm called Smith Ventures, and then selling its banking unit to Commerce One. And then the Smith Ventures and Commerce One would be also closely working together. Yeah. And then earlier, like in the first half of 2025, there was SmartBiz, which is a marketplace small business lender, bought a bank called United Community Bankshares, and then Oak North, which in the UK is a bank, and then in the United States is a fintech software company, agreed to acquire a very similarly named bank called Community Unity Bank. So we're at 4 acquisitions of a fintech, or what I would say like a very digital forward firm that doesn't have a bank charter, buying banks and that's on top of all of the other fintechs and non-banks we've seen apply for charters. Yes. So did you have any thoughts on, kind of the nature of some of these acquisitions or what's interesting to you about them?
I do. Yes. Thank you for asking, Kiah Hazlitt. So I think that one thing that has been strange, I guess, and I'm curious about this is, some of these acquisitions strike me as being driven by like different things, right? So the sort of classic use case for a fintech company buying a bank, which I think we do have some examples of here, is, hey, I just want to acquire a charter so that I can, usually the way it works most successfully is I'm a fintech company that has scaled up a really strong consumer or commercial lending business. And I've worked out all the kinks. I've gotten kicked in the teeth a few times over the years. I've like worked my model out so that it works. I'm acquiring the right customers. And the problem I have is really cost of funds. And so by acquiring a bank charter, doesn't matter what the bank is. I just need the cheapest little bank that's willing to be sold and that I think regulators will approve me buying. And then I will essentially charter strip, to use a term that regulators will use. And I will turn that charter to the purposes of gathering cheap deposits so that I can fund my lending, and then over time maybe expand into more of a full service kind of new school bank. And so we saw Lending Club do that with Radius. We saw SoFi do that with Golden Pacific. So that's like one flavor traditionally. Right. I guess you could say that some of the examples that you listed would fall roughly into that category. So like someone like Oak North maybe would be an example of that in the States. I mean, I guess a Nova is too, but then like there are other ones where you see like a banking as a service angle, right? So again, turning back the clock a little bit, obviously like we saw Jackie Reeses at formerly of Square buy Lead Bank and sort of transform it into a banking as a service powerhouse. William Hockey at formerly of Plaid did that with Column. You're seeing Dara Buckley, formerly of Stripe, kind of doing that a little bit. He actually bought a bank last year. That was another one. Tiny little bank in Washington whose name I can't remember off the top of my head. So you see another version of this, which is, hey, we want to be in the infrastructure business. Sure. But part of that infrastructure, if you're doing banking as a service, is in fact the bank charter. And so we need to have that as a piece of it as well. So those, I think, were historically reasons you would buy a bank. And I guess some of those are still kind of valid, particularly like the lending and then getting a cheaper cost of funding use case. I want to pause here and ask, Innova is buying Grasshopper. Yes. Which, again, Innova's a lender, and so they could use cheaper cost of funds. And so that potentially makes sense. But like, why are they buying Grasshopper specifically? Do you have any sense of that?
So Mike Butler is at Grasshopper, and he was formerly at Radius. So you might have found one of the few operatives who is familiar with this playbook. Yeah. Grasshopper started as a digital-only bank, and they're not a true de novo, but they're very young. They're one of the few banks that was opened, I think, 2018, 2019. Yeah. And they have acquired a consumer base through the acquisition of a an auto club, like a AAA bank. And so the acquisition is a little bit, the customer base isn't as disparate as if they hadn't acquired that and it was only business lenders. And so I wonder if they're, I don't know if a Nova actually wants to be a small business bank, right? And Grasshopper really did start as a small business bank. I don't know, but it makes sense as if you think about like maybe Grasshopper doesn't want to offer a ton of consumer products.
Sure. So maybe there's a tie there.
Yeah, like I guess people who bank at AAA like might not need a ton of loans if you think about they might be an older client base. And so they might have low credit needs, but lots of lazy, sticky money. Right. The other thing too is, I'm actually kind of fascinated by Grasshopper being a young bank, and another one of these banks in this list that I shared is actually a de novo. These are banks that are selling within 2, 3, 5, 10, like less than 10 years. Yeah. And I think that's interesting too. I wonder if that's more opportunistic or if these banks are looking ahead, like these banks, which I think have a lot of advantage because they just got to buy and set up new technology, didn't do the legacy branch approach, and are still being like, we don't. I'll just take the highest bidder.
That is weird, right? Well, so there's parts on both sides that are weird, right? Because one part of it is normally, again, going back to the old kind of model, it was more like, hey, I just inherited this bank from my parents who retired, who inherited it from their parents. Yeah. But I don't really want to be in the banking business. I don't think community banking, the way our bank works, really makes sense in this century. And so I just want to sell the bank and I sort of want to get out of it. So it's like, it's kind of the end of the bank's lifespan in terms of who owns it and them being interested in being in banking. I think that historically is how I've thought about the fintech buying a bank thing, is like, go buy out the tired old banker who doesn't want to do this shit anymore, kind of a thing. But to your point, like Grasshopper, like if you're buying a de novo, like not that long ago, you were all excited about going and competing in banking with a new modern approach and tech stack and less of a branch heavy strategy and all that kind of stuff. And so like, I think it's a good question. Like what changed? And then the flip side that I'm also curious about, you referenced like all the new de novo charters. Is it cheaper to buy Grasshopper than to get a de novo charter? Like, what's the delta between the? It can't possibly cost $300 million to get a de novo charter,
Yeah, surely you could start up a bank for under $370 million.
I know. Yeah, I mean, like I know our friends at Claros are expensive, but they're not that expensive, right? Like that.
The math between doing a de novo and buying a charter is always really interesting. There's for a while it's just, people bought banks because you couldn't get de novo charters. So it it might be cheaper, but like you can't do it. So
we're not gonna let you. Yeah.
I think one of the things that's nice about buying one of these banks is they are probably, if not profitable, close to profitable. And you're working with infrastructure that isn't maybe so old, especially if you're buying a de novo, that you can't just like update it or add to it versus one that would be closer to more of a gut remodel of the bank itself. When you start a de novo, that's a full, like, I'm not saying that's, I think the application is a little different because you have to find your management team and you have to apply for deposit insurance, right? So while it's not necessarily less work, the work might be different. There's potentially more applications to file. And then the other thing too is de novos they take a long time to reach profitability because of all of those investments. Whereas at least with Grasshopper, you're already buying its profitability and then adding to it. What I think is interesting is we saw 4 deals in 2025. And I think that these deals have more matchmaking involved because there's only so many banks that are going to be interested in this and even selling in the first place. And there's going to be only so many like banks that a fintech wants to buy. Like there just aren't, like there's 4,000 banks available. There aren't that many that are going to be a good seller intellectually or from an operations perspective for these fintechs. And we are seeing a lot of fintechs try to apply for charters.
Yeah, I mean, that's interesting, right? Because, and maybe it's not a mistake in the case of Innova that they are like an older fintech company, right?
Yeah.
And so like there might be something to the idea that like for them, they weren't interested in buying like a distressed asset that they thought they would need to like rehabilitate. Like I mean, maybe one way of thinking about it is they actually did want to buy like a little somewhat modern, successful, profitable bank that they could afford, but that they could kind of build on top of and get more value out of through the strategic alignment with what they do, but that wouldn't require them to like start from zero. Whereas I think some of the other acquisitions that we've seen in the past were much more just like, hey, I just need a charter and it doesn't really matter what business is sort of attached to it. And like, I'll just take whatever I can get. And the reason I mention all of that is, and correct me if I'm getting this wrong, but I believe Innova paid about 2.5 times tangible book value for Grasshopper, which is like a lot in M&A terms. And so I clearly they liked this one specifically. It wasn't just we need to find someone who's willing to sell to us.
Yeah, I wonder if that I hadn't looked at pricing. Now I'm pulling up S&P, my favorite.
I'm surprised I got there before you did.
I actually haven't seen that much on this deal itself.
No, not sometimes
when a bank deal happens, people can't write enough stories about it. And there really hasn't been that much on this deal. I wonder if it was an auction process that can happen in banking.
Yeah.
And I also don't think Grasshopper is public either. So we don't have necessarily something to benchmark ourselves to against it.
Right. No, I think that's fair. I mean, the other thing that kind of ties into this that's really interesting to me is, and you and I have talked about this before, but you know, whenever you're thinking about combining bank and fintech company, you have to think about investors and like what they want and who will value what. And it does matter if they're private or public. That matters a lot. But like, you know, one of the reasons you tend to see, you know, either fintech companies resist buying banks or in the case when they do buy a bank, being sort of, I think, happy maybe that they are buying a bank rather than the other way around is that, you know, banks, as we've talked about, tend to be fairly sort of easy and straightforward to value. And, you know, you might pay a little bit more than tangible book value or a little bit less, but like fundamentally, there's a pretty constrained range. And the market sort of evaluates and values banks in a fairly straightforward way, whereas tech companies are just all over the place, right? And, you know, I mean, like, to use one example, like people have sort of speculated like, oh, will someone like a Ramp maybe get a, you know, bank charter? And like, because the doors are open, you could get a bank charter if you wanted to. And there's like zero chance that Ramp gets a bank charter. And one of, I think, the biggest reasons for that is they don't want to tie themselves to that like valuation curve. Like they just like that, the amount of money that they're able to raise from private market investors, they might not even ever go public, to say nothing of, you know, getting a bank charter. And so I think that does matter. And it does also tie into the other example you mentioned, which was Green Dot with Smith Ventures and Commerce One. So basically the idea is Green Dot, a banking as a service bank, is going to be sort of cut in half. The private equity firm Smith Ventures will buy Green Dot's non-bank fintech banking as a service operations. So I guess they're like tech business and their relationships with their different fintech portfolio companies. And then Commerce One, a bank, will then acquire Green Dot's bank and combine it together into one bank holding company. What's interesting to me about that is that very much seems like kind of market arbitrage in the sense that the same person owns both of the acquiring businesses, right? Smith Ventures and Commerce One are both, you know, functionally controlled by, you know, Bill Smith, right? Who is the CEO of Smith Ventures and a founding member of the board of directors of Commerce One Financial, which is the parent company over Commerce One Bank. Like, to me, this is one of those ones where, you know, I think from his perspective, Green Dot is a very valuable business and one that's worth owning the different assets of. But by structuring the deal this way, they can get everything they had before, which is the combination of those two things. but they can keep the banking stuff on the banking side and sort of be valued and be run as a bank.
Yeah.
And keep the fintech stuff that's hard to value and hard to understand with the Smith Ventures private equity group. And so I think that like nothing is really changing. Green Dot is still Green Dot, like in terms of its operations and what it's going to be doing. It's just two different parts are owned by the two different entities that kind of can value and run them appropriately. So I think in some cases you see banks and fintechs smashed together, but this is like, we're going to carefully sort our Lego blocks into two different colors and keep them separate from each other. And so maybe this is just kind of a cyclical pattern that will play out.
Yeah, the bundling and unbundling of banking as a service and fintechs. And I checked, it is the Innova deal for Grasshopper is 2.5 times tangible book value, which is fantastic for bank deals. So they're really, and this was announced in 2025, so at least those deal stats aren't going to carry over this year. But yeah, the Smith Ventures deal, it'll be actually interesting to see how Commerce One is valued going forward, right? And how that might compare to kind of like Green Dot's legacy or historical valuations. I think I've never been like a big stock market person. Like I'm not a trader and I'm not like a price to forward earnings person. Like it seems so sentiment driven sometimes. And so doing something for the valuation, it's like a 2 plus 2 equals 5, right? Like that's what you're trying to tell me, and I'm just like, I don't know, guys. Like
that's not how I was taught to do math. Yeah, no, I think that's a fair point. I mean, it's fascinating because we're coming out of this environment where what you chose to do was basically based on what you were allowed to do. Kind of going back to your earlier point, right? And so like for a while there, I would sort of classify it as like kind of three different eras, right? So like coming out of Trump 1.0 and into the early years of the Biden administration, there was sort of this window where we're not really going to make it easy for you to get a de novo charter, but if you wanted to buy a bank, even if you want to use it for completely different purposes and just strip that charter out and use it in a different way, feel free, go ahead and do that. And so that was Lending Club, that was SoFi, that was any number of these other ones. That was, Jackie Reeses buying Lead Bank in Kansas City. Then you go into era number 2, which is kind of, I would say, like later stage Biden administration. Okay. And that is no. None of these things are going to happen. Banks aren't going to buy other banks. Fintech companies aren't going to buy banks. Banks aren't going to buy... I suppose banks could buy fintech companies. That was maybe the one that was allowed. And we will not be offering any new types of charters or de novos. So like basically no, unless you're Chase and you want to buy Frank and then be embarrassed about it later. That's the only thing that we'll allow. So then you fast forward to now and we're in Trump 2.0. Yep. And it feels like now, and it's kind of interesting actually, now it's yes and, right? Now we're doing like the improv era of like bank acquisitions and chartering. It's like, yes and, would you
everyone
also like
this? Everyone gets a charter and anyone can buy bank. Everyone can buy bank. Yeah.
Yeah, it's like all good. Everything is on the table. And so I guess the question I'm asking is, if everything is on the table, then suddenly you have to make a choice. Suddenly it's not, we're only allowed to do this, so this is what we're going to do. Now it's, we could go through door A, door B, door C. And I'm curious to see how different organizations kind of like figure out which path they want to go down, right? Mm-hmm. Like even, going to, I know we've talked about like national trust charters and stuff, but like to me, like that was almost those crypto companies sitting down with strategists who specialize in helping companies buy banks and basically going, so like, do you think there's a charter that maybe hasn't been used a lot for this, but we could get like regulators on board with it? Do you think that's possible? And they're like, yeah, I think it's possible. And like, it almost is like whatever is in the realm of even vague plausibility, even if the OCC or the Fed or others haven't even considered it, if you can sell it to them, like maybe you can make it happen. So it's, talk about making America great again. Like we are wide open, baby, in terms of like with the options that are available to you.
Yeah. Well, stay tuned. And I'm not sure how many more of these we'll see, but we did see 4 in 2025.
It's quite a few.
I also actually there's a lot of fintech companies, but part of me is like, how many do I think would be interested in a bank charter, what percentage have already applied or acquired one? Like, are we kind of running out of fintech companies and this charter thing? Or
well, no, it's a great point, right? Because
like PayPal's ILC, like that was like a big holdout, right? Mercury, like with the full charter, right? We're just running out of them, right?
No, you're right. I think you're right about that. I mean, it's a really interesting question because it's like you have to be big enough for it to make sense. You have to have the money. You have to sort of be at a scaled point where adding a bank to what you do makes sense. But you also can't be like too good at being a fintech company because then it returns to the thing I was saying before about like, why would we ever drag down our private market valuation by buying a bank? That would be stupid. And so you have to kind of be in this sweet spot. I actually think this would be a good list to build, but like, I guess the category of fintech companies I would watch would be like old fintech companies that never got a bank. And so like a Novo would fit into this category. Even someone like an Avant based out of Chicago would fit into this category. Really any like Prosper would be an interesting one. Like any company that has a really scaled lending business that's kind of old and long in the tooth and really has sort of like squeezed all of the like private market enthusiasm for investing in a fintech company out of their journey, but they're successful and they have a lot of cash. Okay. That to me would be the category of we think we're going to buy a bank. I think if you're too young, if you're younger, kind of like a Mercury maybe, you're probably just going to apply for a charter and not like why do that? Why buy a bank rather than do that? And if you are too like big as a fintech company and too successful, like a Ramp or an Affirm or someone like that, Chime might even fall into this category. You might think, we don't want to add a bank into what we're doing right now. We think it would be not additive to our business. So there's probably a sweet spot to look at.
Yeah. Well, stay tuned.
More to come. But can I ask you one more quick one? Just I want to get your reaction to. This is the reverse of what we've been talking about.
Okay.
But what did you think about Coastal buying GreenFi, which previously was Aspiration?
I thought it was weird.
It's weird. Yes.
And I think we should all just emotionally let Aspiration go. I thought I read what you wrote. Last Monday, this Monday.
This week,
And it was nice. And you were like, I wanted Aspiration to succeed. But Alex, I thought it was weird from the beginning. Like, ESG has gone through its...
it's been through its ups and downs.
It's been through some ups. It's in a big down right now. I thought Aspiration was a little too much, even when ESG was hot.
Oh, me too. I wrote about that.
Yeah. And so I just don't think it's viable as a business.
Yeah.
And I think you and Simon sometimes talk about like, is it a standalone business or is it like a feature or something?
Yeah.
And I don't even know if I think this is a compelling feature per se. So I don't know like what they bought. Did they buy the customer list? Did they buy technology? Like, is it to save...
trick them like Charlie Javis did and they're going to regret this. Yeah.
Was it like did they have like a put or an option in their contract that was like, we could fire sale to you, or like, I don't know, is it a talent hire, like acqui-hire? Yeah.
It's strange, right? Because just to comment on it real fast, I think you don't see a lot of banking as a service banks buy their own programs. That's the part that's weird to me, right?
I've wondered if banking as a service banks should put in, like, I've always wondered, like, should one of the, like, it would be the worst, but should Evolve have bought Synapse? Like, or like if you're using like if you're really reliant on a certain fintech where the viability of the fintech could have like consequences for you as a bank, shouldn't you put that in your contract somehow?
Well, it's a great question. And I do know for a fact that there are quite a few banking as a service banks that are on the cap tables of the companies that are portfolio or that are programs of theirs. And so like there are banks that will do that. But usually it's just like, we want to make sure our interests are aligned. So it's more incentive alignment where it's like, by being on your cap table, we're all in, we'll be great partners, we'll support you. Maybe we'll get warrants for like your future growth so that we can take advantage of that if you really blow up. But I think the problem is, and this is what I didn't understand about the Coastal one, if you buy it, you have to run it. And like the whole point of banking as a service is that you are partnering with companies that have expertise in building products, marketing products, and acquiring customers that you, the bank, are essentially admitting that's not our skill set. We can't do that. We want to enable it in order to bring in deposits or generate loans or generate fee revenue. Like, is Coastal saying they can run aspiration better than aspiration can? That kind of seems like what it is, and I don't understand that.
I mean, when aspiration has fraud, certainly Coastal could do a better job of not...
You and I could do it better than that. Just don't...
not adopting NBA players and then giving them money through
lying about how many trees you're planting.
Deals. Yeah.
I mean, selfishly, I'm glad that some version of the aspiration candle will still be lit somewhere in the industry, because it's like the story that just keeps giving and giving and giving. I don't know that it's a wise acquisition.
Yes, this is a good development of the story. Yeah,
right. It's another twist in the snake. All right, Kiah, should we jump into like the dumbest of all? This might be a new segment for 2026.
Go ahead.
Okay, so I don't mean to like reassert control over this podcast as the host, but I do
I'll allow
think.
It this once.
Well, I appreciate that. I do think that there's just a whole bunch of things that overwhelm my news feed on a daily basis. And
Tell me.
Part of this is being on Twitter, I think, where it's just like, you thought it was crazy yesterday, it's going to be crazier today. But there are so many like dumb things that are happening. And I thought it would be fun to just run through a bunch of them. So I'll just pick one, and then you just pick the next, and we'll go back and forth. You ready?
Okay.
All right. So the segment in our outline, the title of the segment is "It's Bad. It's all so bad." Story number one is President Trump calling for, proclaiming, announcing. I'm not sure what the verbs
you're using here are very interesting.
Yeah, like the verbs matter, which we'll get into. A 10% cap on credit card interest rates.
Right.
This, I guess, just as setup. This is something that has been discussed over the last, I would say, couple of years on both sides of the aisle, actually, because I guess, populism is sort of a circle that comes all the way back around and sort of ties like the far right to the far left in some senses. Bernie Sanders, very supportive of this idea, but the basic concept is that because of the ability to export interest rates, some of your favorite bank policy nerdery, it basically allows for credit card issuers to technically have their credit card business located in, South Dakota, and to export very high interest rates and basically make revolving credit very expensive for consumers. So I guess the theory is, if you found some way, and we'll get to the mechanics of this in a minute, but if you found some way to cap credit card interest rates nationally and prevent this sort of rate exporting thing that's happening, you would be able to lower the cost of credit card borrowing by these consumers, which then addresses like affordability challenges, and I think is kind of the root of where this idea is coming from. Like these evil credit card companies that are preying upon people with very high interest rates. This story is hard for me because it's stupid. It's not going to happen.
Sure.
But it is also not entirely without merit, but not in the way that it's being proposed or discussed. So it's like, I just want to sort of ignore this entirely, but there's the germ of an interesting point lurking somewhere in the midst of all the stupidity. And so I'm having a hard time sort of separating out all of this. I'm imagining, Kiah, that this is like 5-alarm fire in your credit card reward world, right? Like this is like, no!
Yeah, so I think one of the reasons why this specific idea, the idea of a credit card interest rate cap, has so much appeal and salience, like you said, bipartisan support, left and right, is that people kind of understand some things about credit cards without necessarily understanding all of the things about credit cards. And so people understand that credit cards carry high interest rates, and they kind of don't know why those interest rates are what they're set at, or the legal mechanism by which like a consumer in Colorado has to pay a 20% interest rate. But
You're saying they don't know about Didmika, is what you're saying.
Because they don't know about Didmika.
Right.
But one thing I think about is that, like, when this stuff happens, everyone has to explain that, like, yes, banks make profit from this.
Yes.
But also they didn't pull this number out of a hat. Like, there is like and so the question is always like, kind of how much money should a bank be able to make from this? Who should banks be able to make money from?
Yes.
Across what products?
Yeah.
Right. And so, like, I think this idea, like, every time I'm seeing right now this, I feel like, one, I'm not actually seeing enough conversation about, like, things that are laws require acts of Congress and then the president signs them. Like, I'm not seeing that, number one. Number two, like, there's all these questions around, like, okay, why does this proposal have appeal? But also, what would the actual real consequences of this proposal be? Like, they're not, I feel like the consumer education part where it's like, oh, like, Capital One is able to offer credit cards to people with weak credit because they can price it. And the price of a credit card is its interest rate. And some consumers will choose to pay interest in order to have access to credit. And like that, like, what should we do with this information? Right? That person probably wouldn't want to have credit reduced to them because in order for them to pay less interest, right? Like, and so every time this comes up, it's so circular and it's so like, I kind of like can't engage with anyone who said it would help consumers,
right,
without them also acknowledging that one way that in their definition of help, they mean that someone who wants and uses credit would not be able to have it, and they think that's good. Right. And then, like, in my space, I was just going to say, in my space, the one space where consumers deeply, deeply care about interchange is points and travel credit cards. And props to those people, because of all of the personal consumer financial content I consume, that group is the one that probably does the most to understand and help people understand, like, the costs of carrying credit, how these regulations impact their daily lives. It's never hidden from them that the way that we get our points and travel credit card rewards is through interchange, right? And so, yes, that is where I see this story being repeated the most right now outside of our spheres, is that travel space.
Yeah, it's interesting. I was going to say, I mean, I think you're right. Like, the problem with credit cards is credit cards are not for one group of people. Credit cards are sort of for everyone. And it's like, it's kind of the prototypical American invention, right? Where it's like, we're just going to like jam everything together into one massive super product that cross subsidizes everything in a million different ways. And so it's like, you know, when you start to mess around with credit card economics, it becomes very clear very quickly that you're, as a policymaker, you're going to have to pick winners and losers, right? And so, like, I think it is fair to say that people who carry lots of credit card debt are losers in the current credit card sort of trade-off game that's being played right now. To your point, they're walking into it. It's not like that's hidden. There are Schumer boxes. You're choosing to spend money on credit cards. Like, that is a market that the rules are pretty clear in, and you've decided to do that for whatever reason. And by the way, the fact that that market is fairly large and exists is kind of what invited buy now, pay later to come in and try to disrupt that market, right? Because if you think about buy now, pay later, it basically exists to pick off heavy revolvers on credit cards and say, you shouldn't be paying all this interest on this. You should use buy now, pay later instead. So I think you could make the argument, actually, and I haven't seen the executives at Klarna and Affirm really latching onto the story and making this argument, maybe because they're trying to be a little careful with what they say publicly. But like, I think if they were to say, what they would say is, look, the private market is actually working, right? Like, we don't need to cap credit card interest rates because
there are alternatives.
Right. Like, anyone who wants to stop revolving credit card debt and borrow money more responsibly, there are responsible non-payday lender alternatives to that. So that's part one. Second part is, if you use credit cards more responsibly, and like mostly you transact but you revolve occasionally. And when you revolve, it's because your car needs to be repaired or whatever. And it's more the convenience of the liquidity that exists in that moment, which, by the way, buy now, pay later is great, but like, it's not really just a general purpose liquidity tool when you need it. It's not great for emergencies, right? Like buy now, pay later is awesome, but it's not great for like
Christmas. It's bad for car repairs.
Yeah, exactly. And so I think that credit cards definitely have a use as like an emergency backup liquidity in a responsible way.
Yeah.
And what lots of critics of this proposal have said is to price the risk effectively, you have to have a large pool of consumers, and you have to be able to price the risk within what you're allowed to do legally from a usury perspective. And if you limit banks' ability to do that, they will just give fewer people credit cards.
Yeah.
And that will cause some drop in the irresponsible borrowing that is, ending up with people with these massive amounts of revolving debt. But it'll also take credit cards as a valuable kind of emergency liquidity tool out of people's hands.
Yeah.
The third group, which is like you and your friends and the little like kind of area that you're in, is to what degree credit card borrowing, the lending side of credit card business, subsidizes the payment side of credit card businesses. And I've seen lots of research on this. I don't know that there's a definitive like one single answer to it because every credit card issuer's portfolio is a little different. So, Chase Sapphire Preferred, very, very expensive card from an annual fee perspective.
For the reserve,
The reserve, very, very expensive from an interchange perspective. Like it's at the very tippity top of the interchange table. And for the most part, between the annual fee and the interchange rate, that I would imagine pays for a lot of that. I don't think there's a lot of people racking up huge revolving debt on that particular card program. If you go over to someone like a Capital One, their business model is much more dependent on revolving debt and sort of underwriting that debt. So I think it does depend portfolio to portfolio a little bit, but that would be the third group of credit card users who are the ones who religiously never revolve, but rack up a ton of credit card points, miles, whatever, and are afraid that any change to credit card economics, even if it's a little more indirect by capping interest rates, would potentially change their relationship to this product that they use very effectively. So I think it's like we just had to hash that out over the course of like 15 minutes. That's not the conversation that's happening online. The conversation that's happening online is this is either a great idea or a terrible idea with no nuance at all.
Yeah, and I just like one thing that I think is a little difficult right now, going back to everything being really stupid, is that I think if we could one, I thank God I don't work at Politico or I don't work at the Wall Street Journal, where I would maybe have to spend
take this stuff seriously,
2 or 3 days, writing out this story for in 30 days nothing to happen.
Yeah, calling people, doing reporting, asking people questions. Yeah, it would be ridiculous.
Right. And I think that sometimes there's with this proposal, something I think we don't get to always exercise is judgment. Like we just have to be we have to take it on its face as if it's possible. I just need to be he can't just dictate that. That is a rule. That is a law that would have to go through Congress.
Totally.
That's how we got Durbin in the first place.
Right. Well, and as we saw with Durbin, this would be a real tough one for Congress to push through. And they don't want it. They don't want it. There have been individual members of Congress who've come out in support of this. I think if Elizabeth Warren thought Donald Trump was serious, she would be on board with it too. I don't think she thinks that he's serious about it, to your point. But there's not enough votes for this. And it's not just because Congress is in the pocket of big credit card issuers. I actually don't think that's really all that true anymore necessarily, given how things are playing out in crypto and stablecoins and other places. But I do think people in Congress would have actual policy concerns with this, which is it would reduce the overall availability of credit.
Yeah.
And, one of the things that's funny about the proposal that I don't think even Donald Trump has thought about, and again, when I say these things, I'm I don't think he really thinks about any of this more than it takes time to type it onto Truth Social. But if you interrogated it at all, one of the numbers we know that he cares about is just the overall health of the economy and the stock market. Guess what would really hurt the stock market and the economy would be a significant drop in consumer spending financed by credit cards. And so this would send those numbers in the wrong direction, which I don't think the administration wants. I think no one in Congress wants that. And so to your point about why this is so stupid, like it's not going to happen.
Yeah.
I will say, just as one last comment on this, when bank executives sort of scoff at this, I wish they would do it a tiny bit less and would be a little bit more sensitive to the idea that a lot of their customers misuse this tool that they've given them. And it's not to say that like they're doing anything illegal. It's not to say that consumers aren't adults who know what they're signing up for and they're walking into it. And it's not to say that credit cards aren't deeply useful tools, including for liquidity when you need it and you need like extra, like I get all of that. All of that is true. But having said all of that, the germ of the thing that I actually take seriously when someone says we should cap interest rates at 10% is there are a lot of Americans who misuse credit cards in a way that hurts them to the profit of very large corporations. And well, it's been nice to see buy now, pay later come in as like one way of sort of challenging that model with an alternative model. I don't think it's a completely invalid sort of policy instinct to think consumers are getting hurt here. Maybe we should at least have a conversation about that. I think that's valid.
I think that's where they're most vulnerable is that the lack of sensitivity around why people use money. And this is neither here nor there, but like carrying credit card debt, I think is something people feel really like ashamed about. And like I used to have credit card debt and it's because like I made $35,000 graduating from college and immediately was in $40,000 in debt. And it literally like, it felt like it did not matter what I did financially. I was never going to have enough money. And so what did it matter that I also had credit card debt? And like, why should I change anything about my behavior and deny myself a life I wanted to have as a early college grad, so I could like be slightly less in debt, right? It just like didn't matter. And obviously like that's very nihilistic, and Frank Grotman has talked about financial nihilism, and I saw myself a lot in his presentation. And I know I've told you about this, but like it also really pissed me off that like none of my banks seemed to care that this was a problem that I had with money.
Totally.
And none of my banks were like cared that I had so much anxiety and stress about money. And that the only thing my bank ever seemed to care about was like, oh, do you want to travel more?
Like, right.
And so like I can kind of take that, like, I was talking to Matthew Goldman at Totavi about this, like a credit card and a debit card, but a credit card is like it's a product that people touch almost every single day. It's the only financial product people interact with probably every single day. And it's how most people are connected to the financial ecosystem. And I think credit cards are important in part because it's like the one financial product that like a bank or a credit card issuer has been like, hey, what's important to you? And we will give you a product that speaks to those values or rewards you in that way. And I think that's why they should care about this. And they should probably explain like, like they should both explain like we value your business, we value your spending, we value the things that are important to you. And also like, if we give you a tool that's like kind of hurting you as much as it helps you, or is hurting you more than it helps you, like we don't want that either, because actually that's not really good for us it's not good for us that our customer feels that way and feels that way about our product.
Well, I was going to say, like, it's a brand problem. Yeah, no, I totally agree. And I think that, again, this proposal is not going to happen. It's dumb, blah, blah, blah. I do think that these products and the way consumers are using them are actually becoming slowly better. And it's like glacially slow. So I think sometimes we don't appreciate it. That's the bank's
fault. That is all like...
No.
Right?
I mean, it's like, well, it's like I'll give you an example. The CFPB, when they publish their every other year report on the credit card market, one of the things that report has consistently found the last couple of times is that credit card product design is changing in response to what consumers are feeling, what you just described, and pressure from outside competitors, right? So like now, all of these big credit card issuers all offer as a part of their product the ability to take individual individual transactions and finance them, right?
Yep.
Which is essentially a way of saying, hey, revolving debt is expensive, but we also know sometimes big expenses come up that you don't want to pay for all at once. Here's an alternative way to do that.
Yeah.
Guess what one of the most popular features is usage-wise? It's that, right? And so like, I think there are ways to improve both the way that credit card products are designed, how they're managed, how they're serviced, in ways that address that concern without like upsetting the entire apple cart. And again, I don't think that's a nuance that is well expressed in a tweet. Kiah, we have at least one or two more dumb stories to talk about, right?
Well, this one's dumb but a little scary. I don't know.
Yeah, dumb scary is 2026 vibes.
Because we live in like a really normal economy and country. I was on my computer Sunday night and I saw, the Fed sent me an email. Cool. Jay Powell is filming a hostage video where he shares that he has received, and like, imagine this man hustling into the office on a Sunday, putting his suit on, standing in front of the blue curtain and the flag in the background just so. His cameraman is setting up and being like, all right, Jay, go ahead. And he says that he has received grand jury subpoenas threatening a criminal indictment related from like, I think the DC attorney related to his testimony he gave. And you're like, oh my God. Is like, will they never stop insider trading at the Fed? No, that's not what this is about. No, this is about some testimony he gave about the cost of the Federal Reserve office building, a thing I have never cared less about in my life. I've never cared about this. and Powell is like 4 months away from not being the chair of the Fed anymore. And I just, like, what is going on, Alex, that, like, I'm getting hostage videos from my Federal Reserve chairman saying that, like, the DC attorney has some questions about the renovation.
Yeah, it's hard to explain this story to normal people because they'll be like, "Hey, what's the deal with the Fed thing? That seems bad." And I'm like, "Yeah, you know, it's not good. It's not normal. It's not good." And they're like, "Well, why is it happening?" And I'm like, "Well, because the Federal Reserve is renovating their DC headquarters building." And the person is like, What? And I'm like, yeah. And they're like, is it being used to like launder money for drug dealing or something? I'm like, no. They're like, so what's the problem? I'm like, it's expensive. And they're like, isn't renovating any old historic building in DC really expensive? I'm like, yeah. And they're like, is there any evidence of like law breaking? No. Is there anything happening at all? No. So like, why is this happening? And it's like, it's very difficult to have more than a 30-second conversation with someone without this.
Like, I always been like, what's the crime?
Well, right, yeah, like, what's the crime? What's the thing,
like,
you know?
Is Powell, like, siphoning a little off the top? Is getting kickbacks from some contractor? Like,
that would be something, you know?
Imagine if we sent people over jail for renovations running too long or being too over budget.
I'd be in jail. Like, I had a renovation that went way too long. Like, my wife would want to throw me in jail. I mean, the whole thing is so patently absurd that it's really hard to like take these things seriously, right? Like the U.S. attorney had a tweet, you dropped the screenshot in the outline, basically saying like, the United States Attorney's Office contacted the Federal Reserve on multiple occasions to discuss cost overruns and the chairman's congressional testimony, but were ignored, necessitating the use of a legal process, meaning the subpoena, which is not a threat. Sure. And like, okay, so if we were to accept that explanation on face value, a natural sort of follow-up question would be like, why do you even care about this?
Yeah,
like,
do you not have like other things in the office? Like, is it, what is the district DC attorney general's, like, what's their interest in this case?
Yeah, like it doesn't a case, questions. We have questions about a cost overrun. Why? Is there any law that was broken? Like, what is happening right now? So you ask this, like, why is this happening thing? Of course, like 2 days later, it was reported in multiple outlets, my favorite news story that always happens whenever something like this happens, which is like a minute-by-minute accounting of what Bill Pulte has been up to. And like, why is this happening? apparently, reportedly, the reason that this is happening is that like Bill Pulte somehow managed to sneak back into the White House when people weren't looking. He had like poster boards and like kind of visual aids, and you think I'm like joking. I'm not joking. Like, this is what happened with the 50-year mortgage idea, which is now being shelved because it's stupid. He like had like a poster that was like a wanted poster with like Jay Powell's face on it. And somehow that manifested as like actual action coming from the president down to the attorney general. And that's why this got kicked to the next level. And, you know, it's just bizarre because like even this administration, for the most part, they don't do stuff like this. And apparently Scott Bessent at Treasury is irate about this to the point of like might want to punch Bill Pulte in the face if he sees him. And it's because like he knows that like the market is not going to like this. Everyone knows that the market is not going to like this. You had a quote from a Semaphore article, no less than half a dozen GOP senators publicly criticized the Department of Justice publicly, which is not like totally common, for investigating Powell over Hill testimony last year about the Fed headquarters renovation. They include Republicans who already wanted Powell to step down early. I mean, it's crazy. Like, no one wants this. Yeah. No one wants this. And yet it's happening anyway because Bill Pulte found his way into the Oval Office.
Yeah, I think this is bad, Alex. Also, sure. It's stupid. And
it is both bad and stupid.
And actually, I think in January we will get the Supreme Court hearing about, or court case about Governor Cook and whether she can be fired for what they are saying is cause. And she's saying like it's not fraud, and even if it was fraud, it's not related to my duties. And I just I think this is like
Bill Pulte had his fingers on that one too, by the way.
He's all over it. And I would love to say that we can ignore this because nothing's going to come of it. But and I would love, and like earlier I said that I don't really pay attention to stock price movement and like valuations and sentiment. I was like a little surprised to not see a sell-off on Monday and Tuesday after this came out. So I think like the market is at least saying they don't take it seriously, but and I think that's incorrect too. And I kind of wish that these things weren't free, right? Like I kind of just wish that in addition to us saying this is stupid,
there's an actual cost.
You got to say, and now you're in trouble somehow.
Yeah, that would be nice. That would be nice. Well, the thing that's ironic about it is this might actually exacerbate the problem a little bit, because even though Jay Powell's term as chair is going to be over soon, his term as a Fed governor is not going to be. Yeah. And there was, I think, speculation that he might step down from that role after his chairmanship ended. Yeah. But like this might actually have the opposite effect, that even the more sort of moderate members of the administration or Republicans on the Hill like wanted, like he might stick it all out. And if he does, that's going to affect the votes on the committee for what's going to happen with interest rates. And so I just don't think it's both like bad, but also like politically stupid. And that I find puts it in the realm of bad and stupid things for 2026. Kiah, can I give you one more real fast?
Please, one more bad and stupid thing to start off this year. Let's go.
All right. This is bad. World Liberty Financial, which I doubt you've probably used as a customer, Kiah, unless I've totally misjudged you. Yeah. So you might not.
That's not my favorite crypto exchange or whatever it is.
Right. You have other crypto exchanges you prefer. This is the Trump family's cryptocurrency firm. They have joined some of, I guess you could say, their peers in the market, applying for a national trust bank charter from the OCC.
Nice.
Which, in my outline I said is super cool and normal. And I guess I don't have what you'd call a tremendous amount to say beyond this is fitting into this category of bad and stupid. I do think it puts the OCC and Jonathan Gould in a pretty tough position because, you know, for the sake of your credibility and the credibility of the agency you lead, you're going to want to be very careful with this one.
Yeah.
But also, like, your boss's company wants to be a bank, so you probably should figure out a way to make that happen if you want to keep your job, and sort of maintain the level of influence that you have. I will say, just as a general rule, perfect timing in terms of getting rid of any use of reputation risk as a supervisory metric. Like, it's good timing there because
what was the worst that could happen? We got rid of that guidance. I don't know.
Right. So kind of funny timing that way. I don't know. I mean, do you have anything to say about this story? It seems bad.
I like to say the phrase sometimes: play stupid games, win stupid prizes.
Sure.
And I think one of the concerns that Gould has tried to address is that the OCC has the competency now to examine and gauge the unique risks that can come from national crypto trust banks, given its experience with Anchorage. And like I can buy that. Like,
sure.
I can believe that. And one thing I wonder was how much was an application like this contemplated when the OCC was, I imagine, thoughtfully deciding how they should roll back their interpretive letters, how they should evaluate, how much time they should take to evaluate under 100 days on some of these crypto trust charters. The fact that 5 were announced in the same day, 5 banks didn't apply on the same day. So the fact that 5 were announced on the same day said some people got shorter evaluations than others.
Sure.
And so, this is like, we can criticize the previous administration's OCC for putting out those ILs and stymieing innovation the way they did. But like, I guess I wasn't having to think about what would happen if Trump's cryptocurrency trust firm applied for a charter. Like, at least I didn't have to imagine that. No. This is not the financial innovation that I have been seeking. I'm over here just trying to get rid of checks. And like, Trump gets a cryptocurrency firm. The other thing too, and like Gould and the OCC having to evaluate this application comes after, like, Congress didn't make Trump give up these firms, right? Remember, like, Jimmy Carter had to sell his peanut farm?
Yeah.
Like, the erosion of financial interests and the ability of a politically connected person to benefit from financially, and then for that person to like do one more thing, right? Like, he shouldn't have this World Liberty Financial in the first place under what I thought were laws, but were apparently ethics norms. So now we have bought ourselves, he's bought himself this trouble, we have bought ourselves this trouble. And like, then now we get to see just how good the OCC is at regulating some of these things, right? Because we have one where we are genuinely like, hey, I think there's some real problems. There's going to be some real potential weaknesses, potentially.
Yes.
And
I totally
that's
agree.
not like, I didn't want necessarily this in the first place. And now we're all here playing this stupid game.
Well, it's funny because like I get to win stupid prizes by living here and covering this industry, even though I didn't sign up to play the stupid game. So that seems a touch unfair to me. But I will say, to like add to your point, it's just like the ripple effects of this are not going to be good, right? Because
but it's going to be fun.
It's going to be, I mean, again, terrific content. Like 2025, amazing for content. 2026, lining up to be amazing for content. Not so good for anything else, but the content is great. Makes for fun podcasts. I mean, it's hard, right? Because like now we're going to be in a situation where they're going to apply for a master account.
I know, it's going to be so sick.
They are going to be a tier 2,
they're going to get the payment account. We didn't even talk about the payment account. They're going to get that little payment account.
They're going to get a payment account, and it's going to be glorious. And like, so now we're going to get to see like how does the president owning one of these companies apply to the Fed's deliberations about who gets a master account? That's a good question. Another question you might ask, and this is one I would be asking if I was one of those other crypto firms that got a national trust bank charter. So let's say there's some kind of structural weakness in the way that like all of these crypto companies using national trust charters are operating, that the OCC wants to sort of correct and kind of, you know how sometimes like regulation through enforcement, you just sort of say, yeah, we don't really like this, so we're going to kind of crack the whip over here and try to...
banking as a service between 2021 and 2023, right?
Right. So say a version of that plays out here, and the OCC is trying to kind of nudge the market into a safer direction, operationally speaking. Well, who's going to get the consent order? Is it going to be World Liberty Financial, or is it going to be one of the other competitors to that company that doesn't happen to be owned by the president and his family? Like, I have a hunch I know the answer to that question, even though those other competitors might be actually much better operationally at the thing than World Liberty Financial. I don't think they're the ones who are going to get their hands slapped. So there's just, it puts a tremendous amount of very difficult decisions that are going to kind of escalate, I think, over the next, couple of years. And the reason this is happening is that someone earlier in this whole process didn't want to have an uncomfortable conversation to spare us all of these other conversations that were going to be happening. So instead of saying, you can't have a cryptocurrency company and be president at the same time, or instead of, I think it's terrible for the OCC, right? I mean, like, this is an organization that goes all the way back to the Civil War. Like, there are like strong institutional norms and very serious, dedicated people who work at the OCC trying to set a set of rules that will outlast any one particular moment in time. Yeah. It's going to make those people's jobs really, really fucking hard, and that is unfortunate.
I kind of was critiquing whatever decision-making kind of at the OCC led us to this point. But I really take your point really seriously. Like, I want the Federal Reserve and the OCC to be good at their jobs. And I want that. I actually think, and I don't know if it's because I'm a journalist and I'm a referee, but I actually think credibility and being seen as credible and effective is actually part of that. It's not going in and like finding everything that's wrong and getting it fixed. It's actually that people believe that you can do your job well, and they should, even if they don't agree with you, they should still do what you say, because they understand that that's important to this whole industry that is like predicated on trust. And like, it makes me like stressed and sad, and like for the OCC to be put into this position where I think just their decisions will be interpreted in a way that won't always, you can't always say like, well, that's clearly like a disinterested, like totally like, they're just going on the facts. It has nothing to do with who owns this company.
When they put out guidance, right? Like, they're going to put out new guidance on some of this stuff, right? What banks are doing with crypto stuff. There's some guidance is going to come out. And now we have to ask the question, are you doing this because you think it's the right thing to do, or because the president or his family instructed you to do this? Like, that's going to be a legitimate question, much in the same way. This reminds me a little bit this is a silly, stupid example, but like the press secretary running off the podium like seconds before a bet on prediction market would have flipped from one direction to another. Like, I miss living in a world where I didn't have to think that was a plausible reason why a thing happened. And to your point, like, it undermines the credibility of the press secretary when that happens. The existence of prediction markets allowing bets on how long the press secretary's press conference will go on undermines the credibility of the press secretary. The existence of a OCC approved, and we'll see if the approval happens, although I can't imagine that it doesn't, the existence of an OCC approved national trust bank that is owned by the president, it just makes every single decision that the OCC wants to make from then on harder and less credible. And that sucks. Yeah.
And they always say, once you lose that credibility, like it's really, really hard to earn back. And I think that, I guess, like, if I was in charge of the OCC, these are situations where I would be managing them differently, because I care about my reputation still. Just because I'm not, because I see myself as carrying reputation risk. Yeah. Even if even if a regulator wouldn't, can't ding me for that.
Wouldn't ding you for it. Kiah, that was such a depressing place to end. Can I ask you to rant about something real fast? Just to like get us on a slightly different emotional thing to end.
Oh my God. Yeah. Do I have to have a rant? Do you?
No, I've got a topic picked out.
Oh, you got it. Okay. I was like, oh my God.
No.
I just ranted about OCC credibility. Was that not good enough? Okay.
But it was dark. It was dark. I wanted to rant about something more fun.
Yeah. Okay.
What happened with the built card? I know you pay attention to this.
Okay. All right. So, the built card, and I know for you guys have actually talked about its financials. I'm a user of the built card.
You're a customer.
I pay my rent through PayPal or Venmo. I pay like my roommate who pays the rent. Okay. And I am also a points maniac. And so for years, I actually just like use my credit card on PayPal to pay my roommate, which means that I was incurring a 3% fee. And my rent is low enough that like this is one lawn mowing or it's like 2 cocktails kind of thing.
Sure.
And the bill card came and was like, Kiah, thank you so much for your business. We would like to use our card to pay your rent. You'll get points, and then we'll like also waive the fee. So I was saving $30 a month. Mm-hmm. Well, I guess like Wells Fargo got tired of covering my transaction fees on PayPal.
To the tune of like tens of millions of dollars a month with you and the rest of the users.
It was only $360 a year for me. Okay, like I'm responsible. I will take accountability for $360 of that.
Fair.
But
no more.
And then. And like the bill card has like, I think one of the things about its incentives is like you have to put 5 other non-rent transactions on the card to get points every month. So they are trying to incentivize a little bit of daily spending, but like there's no, you have to spend like $500 on the card every month.
Yeah. And you're speaking of the Wells Fargo card that they had.
Yeah. And there's no like, actually, there's no like checking account product with it too. That was like, hey, you need to keep a minimum of like $1,000 or whatever. So
very, very few strings attached, I guess is your point.
Yeah, really. So if you're a points maximizer, lots of things to like about this card. And then what happened with the new card? So Bill, they're ending their partnership with Wells Fargo.
Or to be more accurate, Wells Fargo is ending its partnership with Bill, but yes.
And they announced new cards. So they announced 3 new cards. Mm-hmm. And I was a little curious about these new cards and was even, I mean, you know me, I pay more than $2,000 in annual fees. I was actually willing to entertain the premium card. Sure. And Bilt announced this like more complicated earning structure where basically, as I understand it, you can get points on your rent, but you might have to like pay the transaction fee, or you can earn enough built cash. They can't call it points because they have built points, built cash. So you earn enough cash. It's like Kohl's cash, where like you have to go to Kohl's to use the cash. You have to spend $75 to use your $30 of Kohl's cash. Okay, so you can pay no transaction fee if you have enough built cash to cover it. But what they advertised on their website was that you had to pay no transaction fee, like little asterisks.
Nah, fine print.
And like, so I signed up for one of my, I have to move my card. I signed up for this yesterday. I was like so pumped. And also like, I'm willing to spend more money on this card, but not 75% of my rent. And then I'm also willing to like have more transactions on the card every month. I'm willing to like have a checking account where I would put my money there in order to avoid this $30. But I went from being like pumped about the no transaction fee to being like, wow, that I would consider like to be a serious, like, I don't want to say misrepresentation because they didn't lie. They just like didn't tell the full truth. And that's what people were really worried about. So now the math is that whatever your rent is, you have to spend 75% of your rent on that card to earn enough cash to cover the fee for the transaction. So I have spent
you get points for your rent, but you'd have to pay the transaction fee unless you also spend about 75% of what your rent is on other transactions
on
to
the card
generate
every month. To generate enough cash.
Enough like fake cash to then pay that transaction
and like
fee.
I'm in a position where my rent, again, the fee is like $30 a month, which is like a lot of people would be like, I would never pay that fee. And like I'm a broken person who would pay it. So I've spent all day justifying these $360 in fees I'm about to spend, in part because my points balances are very low, and it's only January 15th, and I got more trips to book this year, Alex. So I've gone back and forth on this card. It's been an intense 48 hours.
I mean, speaking as someone who's on some group text with you, I can confirm that it has been a stressful 48 hours for you. Like, the rest of us are sort of like fretting about the end of democracy, and Kia's fretting about that too. But then also, in addition to that, Built screwing up her her spreadsheet.
I think it's good to have small problems in addition to really big problems. After we recorded this episode, Built came out with a clarification that rent and mortgage payments would remain fee-free. As Alex wrote about in his January 19th newsletter, the company has also introduced 2 paths to earning a variable amount of points on these payments, so it's still a little confusing. But to my point here, housing payments that are made through the Built platform will not have fees associated with them. Back to the show.
Well, I figured that small problem would be a good one to end the podcast with. Thank you for bringing us into that world for a second.
All right. Well, I will see you in Utah and talk to you later.
All right. Thank you.
Thank you for listening to this episode of Bank Nerd Corner. Stay up to date with news and trends in the bank space by subscribing wherever you get your podcasts. Also, if you love FinTech Takes Banking, please tell a friend. Talk to you next time.